In this lecture, we'll be discussing inventory cost flow assumptions. By the end, you'll be able to understand why two companies with identical purchases and sales will report significantly different income figures, and how to calculate the difference yourself. Here's the fundamental problem. Most companies purchase the same items multiple times throughout the year at varying prices. When they sell a unit, which cost is supposed to be assigned to the sale? If each unit is uniquely identifiable, a car, a piece of jewelry, a custom machine, a company can use specific identification to track the exact unit sold and charge its exact cost to cost of goods sold. Simple, precise, and used by high-value retailers and dealers. But most businesses have thousands of identical units. A grocery store selling canned goods, a hardware store selling bolts, a clothing retailer selling hundreds of the same shirt. For these companies, tracking each individual unit is impractical. GAP's solution: allow companies to assume a cost flow, a rule for which costs flow out as cost of goods sold regardless of how the physical goods actually move through the warehouse. This is a key conceptual point. A cost flow assumption is an accounting election. It does not need to match physical inventory and the movement of goods. A company can use FIFO even if it physically pulls its newest goods from the shelves first. Speaking of FIFO, this is the first of three cost flow assumptions that companies can choose from. FIFO stands for first in, first out, and assumes that the oldest costs flow out first when goods are sold. The first costs you incurred are the first ones charged to cost of goods sold. What remains in ending inventory under FIFO? The most recent purchase costs, the newest, typically most expensive purchases in a rising price environment, which is the most common. In a period of rising prices, FIFO produces lower cost of goods sold, higher gross profit, higher net income, but also higher taxes, and a balance sheet that reflects current prices in the inventory line. FIFO is the most widely used method globally and is the only acceptable method under IFRS. When comparing US companies to international peers, FIFO is the most common ground. Next up, LIFO, which stands for last in, first out. LIFO assumes the most recent cost flows out first. The newest purchases are the first ones charged to cost of goods sold. What remains in ending inventory under LIFO are the oldest costs, which in a rising price environment, the most common, that means the cheapest, most outdated prices are still in ending inventory. In a period of rising prices, LIFO produces higher cost of goods sold, lower gross profit, lower net income, but also lower taxes, which that last point is the primary reason many US companies have historically chosen LIFO. The tax savings can be substantial for large inventory-intensive businesses. Critical GAAP IFRS difference: LIFO is not permitted under IFRS. You cannot directly compare its financials to an international competitor's without adjusting for this difference. This is one of the most significant remaining gaps between US GAAP and IFRS. The third option available to companies is weighted average cost. The weighted average cost method calculates a single average cost per unit across all goods available for sale, then applies that average to cost of goods sold and ending inventory. To get the average cost per unit, you simply take the total cost of goods available for sale. Remember, this is all the purchases during the year plus any other costs to get the inventory ready for sale, and then divide that by the total units available for sale. In a rising price environment, weighted average results fall between FIFO and LIFO. It smooths out price fluctuations rather than emphasizing either the oldest or newest costs. Companies handling homogeneous commodities, where individual unit tracking is meaningless, often prefer this approach. Let's look at the three methods side by side with a concrete example. Suppose we buy inventory in 3 batches, and then we sell 200 of the 300 units available. So batch 1, let's assume we purchased 100 units at $10 each. Then we purchased 100 units at $12 each, and finally 100 units at $14 each. So this is a period of rising prices. These 100 units, we have to assume that they are completely identical, and the only difference is that the price has just been going up each time we purchased more of them. We're probably selling them for the same exact amount though, even though our cost is going up. So if we were to look at a T account for inventory and units, we have purchased 100, 100, and 100, which means we have 300 units available for sale. Then let's assume we make a sale of 200 units. If we look at this on our actual balance sheet or in our accounting records, it's not going to be in units though, it's going to be in dollars. So looking at our inventory account in dollars, we have a $1,000 purchase, a $1,200 purchase, and a $1,400 purchase. So our total goods available for sale is going to be $3,600. So then when we sell those 200 units, we need to calculate what is the cost of goods sold. To calculate cost of goods sold using FIFO, we simply need to take the 200 units that we've sold and figure out how much they cost by assuming that we first sold the 100 units that were purchased at $10, followed by the 100 units that were purchased at $12. So 100 at $10 and 100 at $12 means that we have calculated cost of goods sold to be $2,200. And that's assuming that the first purchase was the first one out the door, first in, first out. We can also assume that that last 100 units that we purchased for $14 is part of our ending inventory. So 100 units at $14 is our ending inventory. Now let's look at the same calculation using LIFO. We're still selling 200 units, but this time we're going to assume that the 100 units we sold first were the last in, first out. So these units that we purchased at $14 are the first ones that we sell, 1,400. Then the next 100 units of that 200 unit sale are assumed to be these units, last in, first out. So the $12 per unit were the next ones that we sold. We're going to go in reverse order with LIFO. That means that our cost of goods sold under LIFO is $2,600. And those last 100 units that we purchased first at $10 a unit are represented in our ending inventory. Notice that cost of goods sold under LIFO is much higher than it is under FIFO. We have a higher cost of goods sold, which lowers our net income, but also lowers our tax bill. Our ending inventory on our balance sheet is also shown at a lower amount, even though it's still the same 100 units remaining. We're just valuing it at different amounts. The last option available to companies is the weighted average method, and you'll recall that the weighted average method takes the cost of goods available for sale. That's this number. We have $3,600 worth of inventory for sale, available for sale, and it divides the cost of goods available for sale of $3,600 over the number of units that are available for sale. And that's 300 units to figure out an average cost per unit. So the average cost per unit here is $12. Now we know we sold 200 units, so 200 units at $12 is $2,400. So that is our cost of goods sold under the average cost method. And 100 units at $12 is our ending inventory. Same purchases, same sales. Cost of goods sold, though, differs by $400 between FIFO and LIFO. That $400 flows straight through to gross profit, net income, and the tax bill. For a large company with hundreds of millions of dollars in inventory, the tax savings from LIFO versus FIFO alone can be enormous. Two principles govern choice. The consistency principle requires using the same method year over year, no opportunities for switching. And full disclosure requires companies to state their inventory method in the footnotes so users can make informed comparisons across companies. Key takeaways. It doesn't really matter which units we actually sold. We just need to assume something and be consistent. FIFO results in higher income and taxes in a rising price environment and is required under IFRS. LIFO results in lower income and taxes when prices are rising and is only allowed under US GAAP. Weighted average is easiest to apply and results fall somewhere between FIFO and LIFO. Consistency and disclosure requirements prevent gaming the system. In the in-class exercises, you'll apply each method to the same data set, focus on correctly computing cost of goods sold and ending inventory under each approach.